Hey, everybody. Welcome to Freightonomics. Anthony Smith, along with myself,
I'm here.
Zach Strickland.
I'm here.
Here to talk some freight market economics. And
Guess
today,
what?
we're going to be joined by this guy.
Mike Baudendistel. And it's an amazing day. I mean, we're also live streaming right now, so we're going to be active on LinkedIn if you're watching between the times of 2 and 2:30 Eastern Standard Time.
Eastern Daylight Time.
Eastern Daylight Time, is that right?
Yep.
On Wednesdays. So if you're on LinkedIn and you want to give us let your voice be heard,
Please
give us a
do.
shout.
Please do.
Facebook as well. Or you might be watching a later time on YouTube or on your favorite streaming platform. We appreciate it.
Yeah. So thank you for joining us today, Mike, our rail and intermodal expert. Here to discuss today on Freightonomics, we're going to talk about all the modes of transportation, not just trucks, but we're going to hit all the modes. We're going to hit boats. We're going to hit rail, obviously, and also trucks, but also a little bit of air cargo, talk about those planes. And what they're all signaling for the recovery process in the freight market in general. So, it's been yet another interesting week. We're approaching peak season in the truckload market, the domestic truckload market. We've seen another sequential increase in trucking volumes, as well as that tightening of capacity that we traditionally see this time of year. But is this sustainable? I think that's the biggest question on everybody's mind. We've kind of reached this point of, the market's peaking. We're back to this seasonal pattern, although we're a little overheated. It's almost like the stock market to an extent, like how long can this last with people being unemployed, not spending money? The industrial side of the economy still doesn't look as strong as we think it should for this amount of freight to move through the system. But that being said, we've got some stories of the day that really, go in two opposite directions. The first story is, capacity cuts send trans-Pacific rates into orbit. Now, Greg Miller, our maritime editor out there, writes for American Shipper, does a brilliant job of explaining the interaction between that, maritime ocean freight and the domestic freight market here in the United States, talks about how that impacts us here in the United States. We've seen an incredible increase in spot market rates coming from China to North America's West Coast here over the last several weeks. Mike, you've seen this quite significantly. You monitor this on the rail side because it's almost like a leading indicator. Is that accurate?
Yeah, I would say the ocean rates. I mean, it's a combination, of course, of supply and demand, and I think the supply that was brought back was just they brought it back too far. It seemed like. I mean, it was very hard to predict what the coronavirus was going to take place as far as consumer activity. And the expectation was when we saw these record unemployment numbers that consumers would really not buy anything that wasn't absolutely necessary, and that volumes would just be really sort of in a depression. And so the ocean carriers saw this, and they sort of rushed to cancel sailings and canceled quite a bit in the second quarter. And it seems like maybe they cut back too far, and it's primarily been just lots of capacity being taken out. And it's also a function of a lot of the ocean carriers around the world have gotten bailouts from their respective countries, right? Which has been part of it. And there's really capacity controlled by three major alliances. So if you have a concentrated industry, it's almost like a exercise in Porter's five forces. So these are leading to shippers having difficulty finding good rates. A lot of them are going to the NVOCCs. Because they have purchased capacity in bulk, ahead of all this happening. So the NVOCCs, which are basically brokers for the ocean, are at the advantage because they purchase capacity for less than what the market ultimately is going to bear.
Non-vessel owning common carrier.
Non-vessel operating,
or non-operating,
yep.
Either way. So they of course, they enter in contracts just like a shipper would. The BMOs, or they would certainly, go out. Normally, shippers will enter contracts with the carriers early on. They decided they didn't want to do that to an extent. Some of them and they didn't, they didn't anticipate the fact that the maritime shippers, unlike the domestic trucking market here in the United States, they can control capacity a little bit better than, the carriers here in the United States can. So canceling sailings. But again, a lot of these shippers were canceling their orders in April. As the market was bottoming, as the unemployment rate skyrocketed, et cetera, a lot of these shippers were giving signals to the ocean carriers that they were not going to need this capacity. Now, all of a sudden, demand has come back, at least on the retail end. Anthony, would you agree?
If we're looking at the dichotomy between retail or the consumer-facing segments compared to industrial, both moved up, of course, from historic lows, but there's much more of an apparent, I think, recovery trend happening on the retail side, on the consumer side of things, whether it's just a less bad version happening on industrial production or in the industrial sector. It's still very much a long way to go.
Yeah, and we're going to get into that here in a little bit. But yeah, the expansion of the rates on the ocean side has really put kind of a dent in the shipper transportation budgets. I mean, the supply chains are already, I think, relatively exposed right now in terms of having to deal with all this international risk. China obviously being the epicenter of the COVID-19 outbreak, as well as the epicenter of the trade war last year. So there's a lot of activity going on there. And this is just kind of insult to injury as the demand, even though retail has come back, it's not come all the way back. I mean, except for in certain sectors like the home improvement, consumer electronics, I believe, is doing well as well. Grocery, food, retail, et cetera, has done better. But the rest of the economy still kind of crawling its way back out of this environment. So ocean rates going through the roof right now as the carriers can control their capacity, unlike the domestic freight market. Now, on the other end of the spectrum, we've got the air cargo side. Air cargo rates are now starting to correct, coming from China to North America. Now, if you guys read this article, this was pretty interesting to me because it's more about the commodity that's being shipped on the air cargo side. They obviously don't have the capacity. Right now, it's been reduced dramatically because of the passenger cargo. If you've watched Freightonomics or read some of our articles, you'll know that 90% of the capacity pulled off of, at the peak, pulled out of the skies in March and April. They've started to put some of those back on, but still dramatically reduced in terms of the available capacity. And the spot rates for air cargo shot up as much as $10, $11 per pound, which is extreme in that world, and now starting to come back down. What are your thoughts on that?
Well, I think it overcorrected, at the beginning, and it was really sort of such an extraordinary circumstance with the COVID situation that, people were just scrambling to get the equipment they needed. There was a lot of hoarding of equipment, and it wasn't really clear which medical devices were needed and in what quantities. And so everyone just sort of scrambled to get as much as they could. I mean, you remember all those, reports of everyone's going to die because there's not enough ventilators, and then there became an excess of ventilators. And I think that was just sort of maybe the one that's most visible, but that was sort of seen with other medical devices as well. We're sort of, past the, sky is falling panic, ensuing, type of,
right.
From the coronavirus. And now we're just in this long, miserable tail. But at least we're not at the point where people are, think they're going to run out of supplies next week. So you have seen that shift to other, things that you mentioned, things like, leisure apparel and,
The athleisure.
PCs. The athleisure, which is probably the new business casual, is athleisure. So all of those things that are in demand, you've seen just a shift in what is being demanded, and I would say that a lot of those things are probably not as time sensitive, which is a big component of air cargo, and really the reason why air cargo exists at all. Why you're
right.
willing to pay that premium is you need it right now. Some of that stuff, can wait. Although apparel companies will say, well, that stuff spoils too with the seasons
Yep.
and with fashion trends and so forth. But I think it's been, just lower priority in terms of what is being moved. And then you are starting to see some additional, service in passengers. I mean, it's still a fraction of what is normal. I mean, I think the people going through TSA checkpoints went down to 2 or 3%, and now it's 10% of what it was or something like that. But it's gone up, at least from its low.
Yeah, Eric Coolidge, of course, the writer of that article. Both of these articles are out on FreightWaves.com. Big heavy hitters this week in terms of a lot of traffic on both of those, and I do think it's fascinating to see the disparity between the two modes. You see still capacity tightening on the maritime side, yet it's coming back. Like, again, I don't want to say loosening because that implies that we're starting to see a lot more added capacity. We're not. It's more just a lowering of demand on that end. So both of those are great. So in terms of the rest of the freight market, now we brought you on for a reason, Mike. The rail sector itself is really heavily tied to one of Anthony's favorite segments, next to the consumer sentiment, who he's very empathetic towards. The industrial sector of the economy, heavily tied to the rail industry, a lot of traffic going there. So, it looks like we are in the midst of a continued industrial recession. We don't necessarily have the same signals from a lot of the rail traffic that we would in others. Tell us a little bit about what you're seeing in the rail volumes right now that, give us a little bit more detail about the recovery process.
Yeah, with rail traffic, it's broken down into 20 categories that the AAR reports, and it comes out every week, and so you get a fair amount of granularity. Now, most of the rail carload traffic, if we set aside intermodal units, are tied to the industrial economy in some way. I mean, if you exclude coal and grain and petroleum, you really sort of get a good sense of what's happening in the industrial economy, and those volumes, like Anthony said earlier, they're up off of their lows, but they're still extremely weak. I mean, the rail carload traffic is still down just over 20% year over year. And so that really, you look at that and say, well, there's really been a severe industrial recession. Now, it had been down as much as 30%, but still down 20%. That's just as bad as you saw in 2009 time frame. So it's sort of indicating you're having that type of a recession. I mean, I think going into the year, a lot of companies were cutting, at least companies I follow, were cutting their capital budgets to begin with. They felt like they had enough equipment and so forth. And so that sort of trickles into volumes that you see on the railroads, things like metals and minerals and chemicals and all those things that go into a lot of durable goods, capital equipment. So the industrial economy still seems extremely weak. It seems like there's lots of capacity there. And the portion of the railroad that you see really with a larger degree of recovery, like Anthony mentioned before, is on the consumer side, which manifests itself in intermodal volumes. Intermodal volumes last week were only down, about 5%. So those have really come almost all the way back. Now, it is on top of 2019, which was down about 5% overall versus 2018. But still, that's kind of a garden variety volume decline. So you wouldn't think that necessarily we're heading into a recession, and from that statistic.
So basically the domestic side, that's going to be your 48, 53-foot containers. Then you have your international intermodal side, which is your 20s and 40s. Now, traditionally speaking, the maritime shippers that we were talking about earlier, expanding capacity, or not expanding, but contracting capacity, rates going up. Those volumes, which are heavily tied, and those shippers or those carriers own those 20s and 40s. And we're seeing a really soft, continued decline in 20 and 40-foot volume moving on the rails in the United States still, correct?
Yeah, so we have a fairly unique, very unique data series in Sonar that breaks out the domestic containers and the international containers. And when you look at that and you compare the two, you see that domestic containers, like you said, are rising, international containers are falling, and that falling international is a function of just lower import volume overall, fewer sailings, and I also think higher degree of transloaded shipments where they transload goods from the international containers into the larger domestic containers. And I think they're doing that for a couple of reasons. One, there are an excess of containers currently. This was one of the only years where I can remember we're going into the year that none of the intermodal companies have taken delivery of incremental equipment. I mean, the only containers they took delivery of was replacement, because the containers don't last all that long, 7 or 8 years. And so they were sort of just maintaining their fleet sizes, and then you see the volumes decline. So in order to utilize those containers, there's more transloading, and that benefits the ocean carriers, because they can get they don't have to reposition those containers on the backhaul. They can put them right back on the ship. But really, I mean, one thing that's has come about because of that is there's fewer empty container movements, or what the railroads call revenue empties, and that's created an issue for exporters, because a lot of those 40-foot containers that would otherwise move empty back to the port are filled with exported goods, such as agriculture, such as soybeans that go from the Midwest to the Pacific Northwest and end up in China. So it's created some issues for exporters.
Yeah, that makes sense. I mean, so just to illustrate some of this for the people that may be unfamiliar with the rail, a lot of those 20 and 40-foot containers, they move from China on a boat to North America. They hit a port of Los Angeles, Long Beach, more than likely. He's talking about transloading, a lot of those get transloaded into either a dry van trailer, 53-foot trailer, or another intermodal 53-foot container or 48-foot container, which then moves on the rail, which allows them to position that empty container back on the boat more efficiently than they would if they just threw it on a truck or on the rail directly from the port, shipped it over to Dallas, for instance, and then had to get something else to move it back. And most of the time, those are coming back empty, because we are in a trade deficit almost all the time. So instead of the ocean carriers paying for that empty 20 to 40-foot container moving from Dallas back to Los Angeles to get put back on the boat, they just transload that freight off of those containers and then put that freight or that container back on the boat, which saves them money in the long run. So again, helps the ocean containers, but again, like you were saying, hurts the people that are exporting a lot of our goods across the ocean, because now they have nowhere to put their freight to move it across the ocean. Accurate?
Yeah, exactly. And a lot of the exports that we move out of the U.S. tend to have the transportation cost as a fairly high percentage of the delivered cost, and so that's why they want to utilize those empty containers. It's a less expensive transportation option.
So basically what you're saying is it's good to be in control of your capacity.
Yeah. Oh, yeah.
I mean, the ocean carriers at this point appear to be doing really well. They're probably the most winning mode of transportation in all of this, as a lot of people were concerned about their how well they were going to handle this whole, because they got huge ships, a lot of investment in all the equipment and operation, and yet they seem to be making plenty of money.
And one of the things that you mentioned was that the activity on the West Coast, and that's really the main port that a lot of this stuff comes into. So could you kind of just talk to a little bit more about what's happening on the West Coast right now, what's going on with volumes right now, spot rates, and all that good stuff?
Yeah, I just wrote up an article that we put on a Railway Age website, which talked about sort of the LA metro area, and that's actually been one of the hottest areas in the country as far as just the transportation market is concerned. So we've really seen tender rejections and volumes out of LA rise faster than the rest of the country. It's always sort of a head haul market, because just so much freight comes into that LA Long Beach port complex. But really, you've seen a lot of volumes come not just straight from the port, but also from a lot of the warehousing centers in Southern California, such as Ontario. So you've seen volumes, freight volumes, particularly long haul freight volumes, be stronger than a lot of the shorter hauls. And so there's been the strength has been concentrated from going LA to the consumption centers in the eastern and the central parts of the country. So lately there's been a pickup both in volume on the road and on the rail. The rail can get it to the eastern consumption centers more efficiently, but truck can get it there faster. And for most of this year, you saw truck, because there was a weak truck market, take some share from intermodal. But in the last 30 days or so, they've moved pretty much in lockstep.
Gotcha.
And seasonally speaking, we normally see the peak rail intermodal season occur around September, October, correct? What do you think that this looks a lot like a pull forward to an extent? Do you think we're going to see a muted peak season, on the rail side of things because of this, or?
Yeah, I think you could. I think a lot has to do with consumer demand. I mean, I think another thing that's interesting is, are there going to be peak season surcharges on the ocean carriers, which was mentioned in one of the articles that you discussed, and that it seems almost like it's an artificial shortage of capacity caused by all these blank sailings, but you'd still expect that there would be surge in imports there. I mean, usually for retail, you have kind of two big seasons. You have one before Christmas, and then one that's back to school. Back to school may not happen. It may not happen in some states, not others.
Right.
So maybe you have demand. The inventories don't get depleted for back to school, and those goods get marked down, and it is sort of a pull forward of demand. So you could see a muted peak season. So I think it's a reasonable expectation.
Yeah, that'd be interesting, because I think a lot of what we're seeing right now is this knee-jerk reaction to the surprising speed of recovery. I mean, you get on Amazon right now, you still can't get a lot of the goods that you used to be able to attain within a day or two on your Prime orders. Still, majority of that is sitting offline. I've been to, I'm not going to name names, but furniture stores, because I just moved into a house, and they're talking about their supply chain issues and the ability for them to get, the goods into this country or off the port. For instance, some of it could be just sitting in containers right now. There's all sorts of disconnect in the supply chain right now, globally. Just because there's, maybe they were prepared for certain goods to be in demand, but others were not. So even though we may have a lot of inventory available in certain warehouses, it may not be the right inventory. So I think we're seeing a good bit of that freight getting pulled into the country now as a correctional device, whereas they were canceling those orders in April. Yeah. And I think that may actually float, at least on the maritime side, for the next several months. I think we might see that one. You see what I did there?
I see what you did there.
I think it'll be through July into September, into August, that we will continue to see, tightened capacity on the maritime side. I don't know, however, how that translates to the domestic freight market. I do still think that we're going to see a bit of a correction internally. Again, we got to wait on those boats to come here with the goods that they need, but supply chains are still deficient in certain goods. They still do not have what they need. You go across the board, including home improvement and all those electronics. They still don't have the freight they need. So that means that there is going to be some form of correction moving forward, because you have to have inventory to make money, and all these companies are going to try to gobble up all the revenue they can get here in this third quarter.
What do you think is the biggest choke point right now in terms of having that inventory available? Is it just there's not enough shipping capacity? Is it manufacturing? The manufacturers have to in China have to social distance? I mean, what is the sort of the choke point?
I think you've got multiple. Honestly, I think we've got the fact that everybody forecasted lower demand through the month of May. We've already seen recovery in certain sectors in May rapidly. The industrial side, which we're going to get to here in a second, not so much. But all the other sides, retail, consumer spending, haven't done as poorly as a lot of people forecasted. So those orders were canceled. All of a sudden, they're sitting at home, ordering up athleisure, as you mentioned, things that our lifestyles are all changing now. So we're seeing an increasing demand for goods that we did not have prior to this. And so it's created this vacuum of availability of freight and goods for the right sectors. We're just, the food and grocery sector. It's shifted from that, macro supply chain, Cisco, commissary style, to more of a fresh, grocer type supply chain. And that's not going to come back. That's not going to change in the next couple of months. I mean, we're slowly crawling back to that industrial food production style, if you will, but it's still not coming back. I think we're going to still see this work from home lifestyle continue. So there's a lot of adjustment going on right now with supply chains, with people trying to figure out what people are going to be doing. Businesses don't know how our lives are going to look on the end of this. If we have a second wave, people go back to their houses. The way to mitigate that risk, if you're a business, is to adapt to this way of life. And so if you are starting to see people work from home more often, you're just not going to be able to, like, there's just not enough information available for people right now to make that clear-cut investment in this new way of living. There's still a lot of holdup there. But, we got 5 minutes left, and I definitely want to talk about those carload volumes. Again, this is more tied to the industrial side of the economy. Carload volumes still depressed. Industrial production, Anthony, doing great, right?
Yeah, not doing great at all. And I think we kind of chatted about it on last episode. It's all about perspective. I mean, when you're looking at industrial production, I saw some outlets kind of say, oh, it's a recovery. It's a bounce back up because there was a 1.4% month-to-month increase, but it's still down 15.3% on a year-over-year basis. And so as we look through some of the significant components of industrial production that's going to have an impact, I think, on rail intermodal. We have segments like motor vehicles and parts, which rose a staggering 120.8% month to month, but was down 62.8% on a year-over-year basis. So I think when we're looking in and digesting some of these industrial production numbers, it's important to put it into perspective on a year-over-year basis. And the other thing to kind of keep in mind is where we were this time last year. Manufacturing and industrial production was already in a weakened point. And so as we go through this year, the comps are going to get easier. And so if we're still in that negative growth trend with easier comps, I think that's really going to be telling for what's happening within the manufacturing and what's happening within industrial production.
Yeah, I think I think the big debate here is how much does industrial production help the economy? How much does it represent of the growth and sustainability of our overall economy? The industrial production wasn't great prior to COVID. Now it's really kind of a lagging sector, and you're seeing that in the carload volumes, correct? They're just not, they're returning kind of like what Anthony was talking about. Is that accurate?
Yeah, I would say, specifically for the ones that are the most economically sensitive, you're seeing some of the biggest declines.
Mm-hmm.
So, metals is down over 30%, sort of metals, minerals. A lot of that goes on the rails, and some of that is scrap. Some of that goes to sort of raw materials that goes into other things. But
Right.
but those metals, chemicals, all manner of minerals, building products, those type of things are really depressed and really haven't improved much, other than motor vehicle plants coming back online and those things.
And I'll ask both of you this one. How much do you think that we need to have a strong industrial economy for, the United States general economy to do well? It just appears like we are growing more and more in a service economy fashion, consumer-oriented, technology is booming. How much is that industrial side, and how important is the industrial side of the economy to the recovery?
I would say certainly less than it's ever been before, and I think as years go on, it becomes a smaller portion of it. To me, it's I think you could have a growing economy with a declining industrial economy. I think we've seen that in certain previous cycles. But at the same time, it goes to the companies having the confidence to invest capital too, which
Right.
To a large extent, you have very sophisticated CFOs that have all this data and people reporting to them, and they're making capital decisions. And if companies are not willing to spend capital, to me, that's a bad sign for other things as well.
Correct.
Yeah, I think it's still a very important component for our economy, but there's that balance of capital versus labor, I think, that Mike touched on here. And what's really going to be important is how much capital and technological advancement is going to be made within industrial production and manufacturing in order to improve efficiencies, because the labor aspect is, I think, going to continue to draw down as years go on. And so I think it's going to be an essential part, but less of a human aspect of it, more of a capital technological aspect to it altogether.
Yeah, that's fair. So we've got less than a minute left, and we'd like to end our show with a special trivia question or a debate topic. Today it's a trivia question. I've got one. I'm going to pose it to Mike first. Actually, I'm going to pose it to Anthony first, then Mike. Top 1,000 hip-hop/rap songs of all time.
Oh, geez.
Name one of the top three.
Okay.
According to SiriusXM.
Rapper's Delight has to be on there, right?
It was. You get
Yes.
one. All right, Mike.
That's what I was gonna say. Oh gosh.
Quick.
I'm trying to think of a name. What's the one that Snoop Dogg had that was covered by the chords? Gin and Juice.
Gin and Juice is close.
Gin and Juice.
Dr. Dre, Nothing But a G Thing. With Snoop Dogg was number one.